America's economy just posted a 4.3% GDP surge. Wall Street calls it a boom. But unemployment is creeping up, job growth is slowing, and nearly 1 million more people are stuck with part-time work they do not want. If we are booming, why does it feel so uneven? And who gets left out when headlines say prosperity for all? The answer depends on what you count and who you count. The Bureau of Economic Analysis reported that U.S. real GDP jumped at a 4.3% annual rate in the third quarter of 2025. That is the kind of number that usually makes headlines and fuels talk of a boom. But GDP is just one way to measure output. Gross domestic income, GDI, rose by 3.1% in the same period. Economists often average these two figures to smooth out the noise from reporting delays, shutdowns, and quirks in the data. The average of GDP and GDI for the third quarter came in at 3.7%, still strong by historical standards, but not quite as eye-popping as the headline. A closer look at what drove the surge reveals a mix of factors. Consumer spending stayed resilient, especially among higher-income households. Exports and government spending also added momentum. But business investment actually fell, dragged down by a sharp drop in inventories. That means some of the growth was front-loaded, more about timing than a broad, sustainable push. When growth is this fast, the question is always how durable it will be. Is this a sign of lasting strength or a spike that could fade as one-off boosts wear off? The answer depends on whether demand stays broad and investment rebounds, or if the momentum starts to cool beneath the surface. Unemployment landed at 4.4% in December 2025, a number that looks steady at first glance. But beneath that headline, the pace of hiring has slowed sharply. Payrolls grew by just 50,000 that month, capping a year where total job gains reached only 584,000. That is an average of 49,000 new jobs per month, less than a third of the pace seen in 2024. For many workers, the question is not just whether they have a job, but whether that job is enough. Part-time work for economic reasons climbed to 5.3 million, up nearly a million over the year. These are people who want full-time hours but cannot get them. One retail clerk in Texas clocks in at 28 hours a week, earning $18 an hour. Her pay stubs show steady work, but her diary tells a different story: job yes, full pay no. Long-term unemployment also edged higher, with 1.9 million Americans out of work for more than 27 weeks, a rise of almost 400,000 from a year earlier. Job openings offer another signal. There were about 7.1 million unfilled positions in November, down from the peaks of the previous year. For small business owners, the mood is mixed. A restaurant owner in California says optimism has returned, but hiring remains on pause. She is watching sales flatten and credit tighten, unsure if she can afford to add staff. These numbers reveal a cooling labor market. The economy is still adding jobs, but not at the pace or quality that defines a true boom. Workers and businesses alike are feeling the difference, even as the official unemployment rate stays low. Average hourly earnings rose 3.8% over the past year, according to the December 2025 jobs report. That is a solid gain on paper, and for many workers, it is the number that shows up on their paychecks. But the real story comes after inflation is factored in. Adjusted for rising prices, real average hourly earnings increased by about 1.1% from December 2024 to December 2025. That is improvement, but it is hardly the kind of across-the-board progress that defines a true boom. The Consumer Price Index climbed 2.7% over the year, with core inflation close behind at 2.6%. These rates are much lower than the spikes seen in 2022 and 2023, yet the overall price level is now about 26.9% higher than it was before the pandemic. For most households, that means paychecks stretch less than they did just a few years ago, even as wages tick higher. A renter in Milwaukee illustrates the reality behind these numbers. She works full-time at a medical billing company, earning $22 an hour. Her latest raise felt good until the rent notice arrived. Her one-bedroom is now $1,325 a month, up from $1,050 in 2021. "I am making more, but I am not getting ahead," she says, flipping through grocery receipts. The math shows progress, but the lived experience tells a different story. When inflation cools, it only means prices are rising more slowly, not that they are falling back to where they were. For workers and renters alike, the gap between pay and the new cost of living remains stubborn, even as headline numbers suggest things are getting better. Shelter and food costs have become the immovable objects in household budgets. In December, shelter prices climbed another 0.4% from the previous month. Eating out, whether it is a quick lunch or a family dinner, rose even faster than overall inflation over the past year. These are not luxuries. They are the bills that come due every month, no matter what is happening in the broader economy. Yet when looking at the numbers, consumer spending appears to keep rising. The Census Bureau reported that retail and food service sales reached $735.9 billion in November, up 0.6% from the previous month and 3.3% from a year earlier. On the surface, those figures suggest steady demand, but these numbers are not adjusted for higher prices. When the cost of essentials keeps climbing, it takes more dollars just to stand still. Nominal sales can look strong even if people are simply paying more for the same goods and services. For many shoppers, the reality is a careful calculation. A grocery store worker in Ohio, for example, earns $16 an hour and budgets every paycheck down to the last dollar. Her receipts show the same basket of groceries now costs $18 more than it did a year ago. She still buys what she needs, but there is less left over for anything else. Credit cards fill the gap for some, but that support comes with its own risks. As prices for shelter and food remain stubborn, the illusion of booming consumption can mask the underlying strain. The story behind the sales figures is one of adaptation, not abundance. Household net worth in the United States soared to about $181.6 trillion by the third quarter of 2025, fueled largely by rising stock values and gains for those already invested in the market. For a financial advisor in New York, clients saw their portfolios climb, unlocking new spending and investment opportunities. But the story looks very different for people hoping to buy a home or keep up with bills. Nearly 4.5% of household debt was delinquent by late 2025, the highest rate in over a decade. In Phoenix, a young couple abandoned their search for a starter home after mortgage rates hit 6.06%, and existing home sales slumped to just $4.06 million for the year, the lowest since 1995. While asset holders watched their wealth grow, millions faced rising debt and frozen housing markets. The gap between investors and everyday buyers keeps widening, reshaping what prosperity means across the country. Small businesses are reporting a new sense of optimism. The National Federation of Independent Business Index reached 99.5 in December, a level not seen since before the pandemic. Owners are feeling more confident about sales and expansion, even as hiring remains cautious. But across the country, manufacturers are facing a different reality. The ISM Manufacturing Index landed at 47.9, a signal of contraction for the sector. Factory floors are quieter, and new orders are harder to come by. Productivity, on the other hand, is rising fast. The third quarter brought a 4.9% annualized gain in output per worker, the strongest in years. Corporate profits surged by $166.1 billion, lifted by strong margins and cost controls. These gains are showing up on balance sheets and in stock prices, but not always in paychecks or new jobs. The divide between Main Street and Wall Street is growing, with prosperity concentrated in some corners, while others wait for the tide to reach them. Today, record wealth and strong headlines mask persistent stress for millions. Real wages are up just 1.1%, housing is still out of reach, and confidence is at decade lows. Until prosperity feels broad, not just statistical, the story is not boom or bust. It is who gets to call it a boom at all.